Hey, welcome to the Retirement Answer Man Show. My name is Roger Whitney. I'm your host. This is the show to help give you the confidence to rock retirement. I'm here with Andy Panko, a financial planner, Tenon Financial. And what is the name of your Facebook group, Andy?
Taxes in Retirement.
Very exciting name. Taxes in Retirement Group. Which you have how many members in your Facebook group?
It's over 16,000 now and growing by 200 to 300 per week.
Yeah, so if you want to go deep into taxes outside of this monthly theme, you can definitely go there. And you can also check out the Rock Retirement Club at rockretirementclub.com, where Andy and I actually had a live meetup last week where we, with members live, walked through a tax return and explained it to those that aren't as familiar, but also had an active discussion on how do I read this, and most importantly, how do I use this to optimize my retirement plan? That was a blast, Andy.
It really is. It was a fun time.
You are a natural. So today, though.
What? I don't know, but thank you.
Well, we talked about chair dancing. We're good at chair dance, sort of. We think we are, but until we stand up, to stick with the dancing thing.
It's all on the shoulders.
You're going to regret that you told me that last week. And this is our second YouTube show, so we're excited to have that going on. So if you're just tuning in to the podcast or on YouTube, last week we talked about retirement tax management. We set the stage of why it's important and talked about the tax code. This week we're going to talk about retirement tax bombs. That's a good, catchy name. Mm-hmm. And then next week we're going to talk about the toolbox. We're going to start to talk more proactively about, okay, but what do I do? What levers do I have to use to, defuse the bombs? And then in the last installment, we're going to talk about the integration of these tools in your actual plan. So hopefully this will give you a framework to think in an organized way to try to get to a good decision for you. One very important thing to say is that Andy and I, we know each other very well. It's been a blast getting to know him. We don't know you. You don't know us. So we're not going to give you any advice. This is helpful hints and education. And you should talk to the people that do know you, your tax advisor, your financial advisor, etc., before you do anything, okay?
Definitely.
So let's transition and get into some tax bombs. I held my finger up to say, don't say anything, Andy, and I forgot. I'm on video now. I got to remember that. So we're going to talk about some hidden tax bombs. And why don't we start off with the first one? Which one did you think of first when you think of a tax bomb in retirement?
Let's start with required minimum distributions, because this is a bomb that can beget other bombs.
And everybody's going to have them, and they're different size for everybody.
Yes. So the benefit of tax-deferred accounts, be it 401k, 403b, Federal Thrift Savings Program, IRAs, etc., is that contributions you make often get you a deferral on that amount of contribution. So I hesitate to use the word tax deduction. It may look and feel like it because the contribution in the year you make it does reduce your taxes or your taxable income by that amount. But it's not really a deduction. You're just deferring the taxes to be worried about some point down the road. Sounds great while you're working, but eventually the government makes you start taking money out of those accounts because it makes you have to pay tax on those accounts. It wants its tax at some point. So under current legislation, RMDs need to start in the year you're 72. For what it's worth, currently that's about, in the year you're 72, you need to take out about 3.9% of your tax deferred account balances. And then every year that percentage goes up a little bit. I think by the time you're 115, it's like 50%. And it's sort of scaled all the way in between. Yeah. So, maybe the dollar amount of your RMD might go up. Maybe it goes down. If your account's growth outpaces the amount you're taking out, then it's going to keep growing and growing. But yeah, so at 72 at the latest, you need to start taking money out of your accounts. And then every year for the rest of your life, you have to take money out.
And the idea here is the government is going to get their money. And they're legislatively have said 72 is when this is what this money was meant for, you to supplement your retirement income. Michael Kitces, prolific writer on all things financial planning, when he was a member or a guest in the club, he had a really good way of thinking about taxes, I thought, Andy. And that was, it's never a question of do I pay the tax or do I not? Everything is a question of just timing, right? It's going to be paid. So whether is the tax deduction to you worth more today than paying taxes later? Everything is a timing consideration. Even like we talked about a concentrated position or a high capital gains position. Not wanting to sell it because you don't want to pay the tax on the gains is really not a decision not to pay the tax. It's just to delay the tax. The only way you actually get out of the tax right now anyway is to die or to have the value of the asset go down and now you don't have a gain anymore.
Or donate it away, but you're not getting
point.
use of it. You're getting the benefit, the value of having donated something. But yeah, you can donate it away as well.
So when you think of RMDs, usually the first thing I do when I'm thinking about trying to diffuse this bomb is, one, I want to get an idea of what we call it a bomb because you're going to be forced to take money out at age 72. So if you're 60 years old today, and I didn't do this math, so I'm just going to make numbers up. If you're 60-year-old today, and let's say you have $1 million in a IRA, and you assume, I don't have my HP, I never do math live, so I'm not going to do it. Maybe Andy will. So you have $1 million today, you're age 60, and it's going to grow, let's assume, at 5% a year. Andy's entering the numbers. Thank you, Andy. What is the value of that asset at age 72?
It is just shy of $1.8 million.
Okay. So you can take the money out today, pay tax on $1 million, or it's going to grow to $1.8 million at age 72. And then what would be the first year RMD, just approximate? You said about 3.9%.
It would be about $70,000 on that $1.8 million.
And so that I usually like to do that calculation first just to get an understanding. If we don't touch the IRA because we have other assets, what is my projected required minimum distribution going to be? And that gives you at least some framing of, well, how can I reduce these RMDs by diffusing it via some vehicles we'll talk about next week? How do you usually approach thinking through this bomb?
The same. While it's good to try to project what the account value might grow to, we don't know, obviously, especially 12 years down the road. It doesn't mean you don't put some number to it and try to come up with a reasonable guess, but maybe it'll be $1 million, maybe it'll be $3 million. Now, if it's like the last 10 plus years where the stock market's been on a tear, a lot of people have a lot of money in tax deferred accounts. Good problem to have, but it's more than they were assuming they'd have. So the RMDs for them could be substantially higher than what they may have thought they would be, if they even thought about RMDs at all. Frankly, a lot of people aren't aware of this. So yeah, you have to try to put some numbers to it, but don't get too hung up on it because we don't really know exactly what's going to happen with financial market returns, obviously. But I do come at it from the same starting point at least.
Okay.
And the reason why we call it a tax bomb, that may be a little sensationalist, but some people do end up taking out more than the RMDs anyway, just because they have to, in which case this isn't necessarily an unforeseen problem. But as I referred to before, there are a lot of people who do end up with a lot more retirement assets than they thought they would have. They may not need the amount of money that the RMD is requiring them to take. So now you add this RMD to your gross and taxable income on top of your other sources, be it Social Security, pension, rental income, dividends, interest, part-time job. You may be stuffed with more taxable income than you're envisioning and than you want, and you may not have control over it because RMD is what it is. You have to take out at least that much by definition. It's a required minimum distribution. And depending what the tax rates are like and the rest of your financial situation's like at the time, you can be in a pretty bad tax scenario as a result of it versus if you consciously took some out earlier when you had a little more control over taxability of things. So that's what we mean when we say it's a bomb. It's not this doomsday event for everybody,
No,
but for
not.
a lot of folks, it is an unwanted tax scenario. Yeah.
We went a little bit too internet clickbaity on the baity on the bomb.
It would have been much better if we had like a soundbite, one of those sound effects that would really drive it home.
And you hit on something that's important. So we don't know what it's going to grow to, and we don't know how it might impact some of the other bombs that we're going to talk about in terms of these surcharges. And the assumption, because I'm an older vintage of human than you, Andy, so the assumption growing up has always been for those retiring now and just before is the sale was, hey, you get the tax deduction today when you have high income and a long time frame. And then in retirement, when you are in a really low tax bracket, just like your grandparents that live in Florida, you can take the money out. So you avoid it when your tax bracket is high, and you harvest it when your tax bracket is low. And I think what a lot of people have discovered is, wait a second, I'm in the same, or in some cases, a lot higher tax bracket than I ever anticipated I would be. So it changes the dynamic of that.
Right, definitely. It's not the old adage of your peak earning years are going to be your highest tax environment years. That's not always the case. Some people, it's quite the opposite.
And then we factor in I hate speculation, by the way. Like on tax code, I hate speculation.
Right.
I like to deal with what I know. But we're in the age of speculation at the moment because we have all these proposals out there for next year. Is we don't know in the future what a distribution from an IRA will impact in terms of Social Security, Medicare, taxation, all these other things, because they can change the rules. Well, let me rephrase. We can change the rules by agreement through our government any way that we want. And it feels like this is a bomb because this gets people really worked up. And I think I want to go back to what you said last week, Andy, is it's going to be okay. We don't want to let this be the tail that wags the dog, but we just want to be aware.
That's right. Be aware of this. Be aware of what can change. The only thing constant with tax legislation is that it will change. We don't know what those changes may hold. If I was a betting person, I would say chances are taxes in some way, shape, or form will be higher in the future than they are currently. But we don't know, right? So we kind of do some educated guessing with all this.
When I have that conversation, I go back to, well, it could be higher, but maybe not for you in retirement. It also could be a different tax scheme. Perhaps we have a VAT or other things that we adopt what other places in the world have done. We just don't know. But we do know that we will have to have these required minimum distributions, and it's something we should at least be aware of. I think that's the key, right?
Yes. Yep, exactly.
All right. Let's put that bomb aside. It hasn't blown up. Let's go to the next one.
Diffused. So the reason why I said let's start with that is because that's a tax that can beget more taxes. Let's go to Social Security. So now, currently, under federal tax code, no more than 85% of your Social Security will be included as taxable income. There are some people who pay 0% of their Social Security is taxable. Some people are at the 85%, and then all sorts of ways in between. Now, what determines how much of your Social Security is taxable? What I mean by that is between 0 and 85. It's based off your other sources of income. I won't get too into it. There's this other definition of income called provisional or combined income, which is the measure of income Social Security uses to determine how much of your Social Security payments are taxable. Just know that all else equal, the more gross income you have, the higher percentage of your Social Security will be taxable. So let's bring this back to RMDs. Let's say you don't need the additional money from your IRA, but you're of RMD age, so the government tells you have to take at least this amount. You take that, that's considered gross income. That now can cause your Social Security, more of your Social Security to be taxable. So this is one of those stealthy retiree-specific taxes that not being aware of your income or having too much income can sort of beget more tax by way of making your Social Security more taxable, I should say.
And so you're paying taxes on the withdrawal, your required minimum distribution, and now potentially you're also paying another tax on your Social Security payments.
Exactly.
And the calculation, so I was thinking of from last week, Andy, of this is when Social Security looks at your income, it's looking at your gross income, and it's sort of its own special definition of modified, or is there any modifications there?
There is. So it's technically your half of your Social Security. So whatever gross amount of Social Security you get, take half of that. Add to that your non-taxable interest income. So things like interest from municipal bonds. And add to that all other of your gross income. That collectively is what's called your combined or provisional income. You then run those through a few different tiers to figure out how much of your Social Security is taxable, and there you have it. Now, one fun fact, it's not so fun, but the income thresholds at which the different percentage of Social Security is taxable kicked in have not been indexed for inflation or increased since they were first put into place. I think it was 1984 is when Social Security first became at least partially taxable. Prior to that, Social Security was not federally taxable at all, period. Starting in 84, give or take a year, up to 50% of your Social Security was taxable based on these provisional income levels of up to $44,000. $44,000 was a pretty sizable amount in 1984. The threshold is still $44,000 today. So here we are, 30 years later. There's inflation. People have higher income, so a lot more people are now sort of sucked into having their Social Security taxed because the income level at which tax is triggered off has not increased in 30 years. So not so fun fact. And then in the early 90s,
way of accomplishing that.
It is a stealth ongoing tax increase, in effect. By not indexing it for inflation, more and more people are impacted by this every year. And then in the 90s, 93 maybe, they added the up to 85% of benefits are taxable. So it's no longer capped at 50, now it's up to 85. Who knows in the future? Maybe, again, just me guessing, maybe at some point 100% of Social Security becomes taxable. I wouldn't be surprised if that happens. But we don't know. That's just speculation on my part.
So let's take a little sidebar here on Social Security. Okay.
Let's.
And because Social Security is in the news, and it has its regular rhythm of, especially when the report comes out of its feasibility long term. And I think there was one recently, and they always have these dates of when it goes broke, or forget the term that they use. Let's talk about one. Does it really go broke, or is that the line where they have less money coming in that they're paying out? Right?
The latter.
Yeah.
Yep.
And
so,
go ahead.
It's just saying, yes, you will read headlines, exaggerated headlines that say Social Security will be insolvent, the system is broke, et cetera, et cetera. All that's going to happen, as projected now, if there's no changes made to the system starting in 2034, as of now, there will only be enough income coming in to pay out, I want to say it's 78% of benefits for the next 75 years, I think it is. So what's actually depleting is what's called the trust fund. For the last however many years, a few decades, I think, the system has been taking in more money than it's paid out in benefits. That surplus stays locked up in this trust fund. It's not used for general government purposes. It's not rated. Yes, the money is invested in U.S. Treasury bonds to earn interest. So indirectly, sure, the borrowings of those bonds are used by the government, but those bonds are always paid back. They've never not paid them back. And what happens is, starting this year, per the projections, the system will start paying out more than it's taking in.
Meaning
the deficit will be until the deficit will be funded by taking money out of the trust fund to pay that extra money, each year. By 2034, it's projected the trust fund depletes down to zero, at which point the income will only be about 78% of the necessary money going out. So Social Security is not going away. Payments will not stop. Worst case, if nothing changes between now and then, which I suspect changes will happen, but if nothing changes, starting in 2034, roughly, they'll only be able to pay out about 78% of promised payments.
And so then the question would become, well, should I assume that I'm only going to get 70% or whatever of my payments if I'm going to be living there? And I would say no. My thought is that there are a lot of fixes to the system that really change the dynamics dramatically. It's increasing the limit on wages that are taxed for Social Security, which is currently about what, 140-ish or I forget where it's at.
140, give or take.
That's why I think it's around 140. So you could increase the amount of income. So if you earn $250,000, all $250,000 has the FICA tax. There's increasing the age of when you're allowed to have full retirement benefits. And you talked about the tax part of it, Andy, where that hasn't been indexed for inflation. If you look at the age that you reach full retirement age, it's been tweaked a few times, but it's pretty close to where it was back in the 40s when Social Security scheme first put into place, right?
Correct. Yeah, it started at 65 when the system went into place in 1935, and as part of the 1984 revisions, because at the time the system was really strained. The demographics were already in place. The baby boom was established. They were boomed at that point. So the writing was on the wall that the system was going to be strained. So 1984, under the Greenspan Commission, Alan Greenspan at the time, figured out how do we bolster the system. So there's lots of changes that could be made. The few that they did was increasing the age at which you can get your full benefit. That's when they started putting in place the taxation of some people's benefits, and I think there were a few other changes at the time. So there's lots of levers that can be pulled. The problem is none of them are going to be palatable. They all boil down to ultimately paying out less or having people pay in more, neither of which people are going to enjoy. So it takes a lot of political will to put your neck out there and vote for one of these changes. But they will happen, probably the 11th hour. We just don't know what combination of changes will ultimately be put in place.
Yeah, and I think it's really important, and I know we do this, I think we've done this really well in the Rock Retirement Club, is it's very easy to let the conversation devolve into political gamesmanship and discussions of what's right and what's wrong. And on a macro level, those may be very important discussions to have, right, in the political realm. But when you're doing your retirement plan, focusing on that aspect of the macro doesn't help you at all with what the actual rules are and how you create a great life. And it's very easy. I think this about inflation and markets and valuations. At the end of the day, you have to bring it back to what can I do next to improve my plan and make it more robust in order to rock retirement. And in the club, I think I've never had to enforce our terms of service or our rules of conduct because we don't have political discussions. We deal with what actually is happening, and I think that's really important here.
Super important. I don't care if you're red, blue, or purple, or some other color in your political leanings. Your opinions and your views, your likes or dislikes about who's in office, who's not, has nothing to do with it. You have to roll with the punches of what you're dealt. To affect change, or try to affect change, write your senators, write your representatives, support tax lobbying foundations that align with your beliefs about taxes. That's how you can get things changed. Going on Facebook, commenting on an article online, going in the Rock Retirement Club and spitting ill about some politician does nothing. It's counterproductive.
Your life and your plan.
Exactly. It does nothing to improve your life, your plan. If anything, it just brings down people around you because you're stirring the pot and causing trouble. So stick to the facts. Be pragmatic with how you approach your taxes and their impact on you.
And that's really, now this is a sidebar to a sidebar, isn't it?
I love it.
And I think that's really important, even when we talk about valuations I think when we think in the internet, outside of this channel, hopefully, and Andy's Facebook group and the Rock Retirement Club and our podcast, is all about tweaking things that either excite you or scare you about retirement in this case, right? Whether it's the markets, whether it's, health of older people, all these things, they're going to pull you into things that disempower you and steal your agency and distract you. So don't look at it. Focus on creating a great life because we all can do it. All right, back. Close that sidebar. Close the next sidebar.
Next.
Let's go on to the next one. Would that be ACA subsidies?
Sure. Let's talk about ACA subsidies. So this won't impact everyone, and this isn't necessarily retiree specific. What it is ACA stands for Affordable Care Act, which is the sort of government-run healthcare exchange program. If you are not covered by health insurance through work or through a spouse's work, you don't have a lot of options for where you go to get health insurance. You can wing it and not have insurance. You can maybe join some faith-based health sharing program, which isn't technically insurance, but sort of loosely looks and feels like it. Or one of the other most common options is to get a policy through the Affordable Care Act, otherwise known as healthcare.gov.
And this all happens if you're below 65, before Medicare.
Great point. Exactly. Below 65, because once you're 65, then you're Medicare eligible. So where this manifests itself with retirees is, let's assume you retire relatively early, 55, 60, whatever. You can probably extend your employer health care coverage to a year and a half through what's called COBRA. But when that runs out, now what do? Most people, the typical best option is to get a policy through the Affordable Care Act. Now, these policies aren't necessarily different than what you can get yourself directly per se, but if you get it through the ACA, there are some restrictions the government puts on it. But more importantly, you can possibly get pretty sizable, potentially sizable subsidies in the form of tax credits if you can keep your income below certain thresholds. So let's assume you're 60, you just stopped working, your insurance ran out, you got 5 years till Medicare. You can get your health care close to fully paid for, or at least the premiums close to fully paid for, if you can manage to keep your income low enough until you're 65. So this isn't really a hidden tax bomb. It's more of a foregone opportunity if you're not able to keep your income low. That's probably a better way to think about it.
And also it's because we have clients who are managing for ACA subsidies. You actually can't have your income too low either, because then you'll go to Medicaid.
Right. The way it works is they key your income off of the federal poverty level, which for a single person this year, I want it's like $13,000, a little more, a little less maybe. For a married couple, I think it's 17. If you're in a high cost state, I believe that's Hawaii and Alaska. The levels are slightly higher, but otherwise it's what I mentioned. If your income is below the federal poverty level, you're not eligible for these credits. You're on Medicaid. Not to say that's necessarily bad, but that may not be what you're shooting for. So the goal would be to get yourself at least a level of income that's 1 time the federal poverty level. If you're married, these things are, if you have other dependents, these levels are more. Yeah. So if you have like dependent kids, yeah. But if it's just you and or your spouse, then your level is going to be $13,000 or $17,000. So historically, the ACA credits and your ability to get these tax credits were keyed off of if your income is between 1 to 4 times the federal poverty level, you're eligible for some scaled amount of tax credit. Once you exceeded that 4 times level, boom, it's a cliff. You're done. You're no longer phased out. You're just you're hard phased out. You're no longer like glide pathed out. Starting last year and this year, and I don't know if this will be extended as part of the.
I think 22.
Oh, it is. Okay.
I think so.
That's right. Started this year and into I forget, but the American Recovery Plan Act or something made it such that there's no longer this hard stop where once your income hits 4 times federal poverty, you're no longer blocked out. Instead, it's this more gentle path. It's based on, I think, 8.5% of your AGI or something is what you're supposed to pay to healthcare. ACA credits are a lot more complicated. It's based on where you live, what policies are available to you. It's keyed off what's called the second lowest cost silver plan. I'll leave that one there. That's a whole other rabbit hole. But the point is, more people now are potentially eligible for getting credits than they were prior to these changes. So if you're in a position where you're on ACA insurance and you have the ability to manage and massage your income to stay within this band to get yourself some credits, that may be the right opportunity for you. Otherwise, if your income's too high, you're not going to get any credits, or you'll have a small amount of credits.
Yeah, and let's talk about the meat on the bone. So I'm just going to make numbers up here, but let's assume without these credits that your premium is $1,000 a month. And assuming you're able to qualify for ACA credits because you keep your income within this band, like Andy's talking about, your premium could potentially be totally paid for or be cut by half or more.
Or so more, yeah.
It's a lot of money.
Definitely.
And so it's something to be aware of as you're building your withdrawal strategy, because let's loop back in the RMD bomb, right?
Right.
Traditionally, we let our tax-deferred assets continue to grow. And if you have enough after-tax assets to be in that band, you can get a substantial discount on, or I'm going to call it a discount, it's credit, on your ACA subsidies and potentially save 10, 12 grand a year, let's say.
Sure.
Or you could take IRA distributions, pay 12% bracket because you don't have a lot of income, but that may push you into losing some of those credits. So you can see this is where that multi-dimensional aspect is coming into play here. How do you figure this out? My suggestion would be you have to build a model. So, in the club and in the course and even in planning, my first goal is always, I'm interested in yours, Andy, I want to get to a retirement plan of record, the initial iteration of how I'm going to pay for retirement. And it's really important to get to that because that will help you understand what your potential tax liability with that plan is. That gives it substance. This is how I'm going to do it. And this is some of the implications I can tease out of it. You have to do that because once you do that, now you can create these, well, what if? Let's create what if version 2 of I'm going to try to solve for ACA subsidies. And this is the ripples that it has over this plan of record, what if scenario, over multi-year with a ton of assumptions in it. And in some cases created 3-4 different what if scenarios to try to tease out making what Andy so aptly called last week our best guess of what we're going to solve.
Yeah, that's it. There is a lot of subjectivity and sort of gut feel about not just you, but you, the planner / advisor, but also the client. What's the client comfortable in doing? Our job is to lay out the pros, the cons, the things to be aware of, and the disclaimer that this is an educated guess. We don't know how big your tax issue is going to be in the future. We don't know what tax legislation itself will do. Based on what we know now, yes, here's some projections. Here's what seems to make sense. And it's also a function of bird in the hand is worth two in the bush. If you're able to massage your income low enough that you can get $1,500, $2,000 a month in ACA credits, it's tough to give that up, to say, you know what, you have a couple $1 million in your IRA. I think it would be better for you to get ahead of that, distribute some of that now, pay low tax on it. The downside is you give up your $2,000 a month in ACA credit. That's a tough pill to swallow. I can't guarantee that taking the ACA credits and letting your IRA continue to sit and bake will ultimately be the better play. But I can say, here's $2,000 in hand per month right now if you do this. That may be hard to give up for people.
And what is and this is essentially what planning is, because it's not figure outable. And that is uncomfortable. And that's why you need to have a really solid process for thinking through it. And this is my opinion, what you don't want to do is you don't want to do what you're probably most attracted to is to find or hear someone or some article that says, this is how you do it and it's the right way. That is intellectually disingenuous because there is no right way. But that is attractive to us. I think of, Andy, this makes you, as you were talking about this, I was thinking back years ago when my mom had cancer. and that navigating the treatment options with the doctors. And man, when you got cancer, how do I fix it is really all you all you care about. How do I fix it? And if you've ever been in a medical situation, you don't typically get, well, this is how you fix it. You get options, and they explain the pros and the cons and the probabilities, and ultimately they help you make an educated guess based on your situation. In my mom's case, initially it was doing the therapies and everything else, and then she did holistic along with that. But ultimately got to the point of the option of, I ain't doing anything else. I'm just going to stick with this plan of record and live my life. That's a dramatic way of thinking about it in a literal life and death decision, but that same dynamic applies in retirement planning. And it's really important you understand that. Otherwise, it's very easy to get led down the perfect strategy to help you avoid. And that's probably not going to help you rock retirement.
And there's so many competing things. You can't possibly solve for all these little gotchas we're talking about. It's not possible to optimize each of these 5 or 6 things. You're going to give up one at the expense, benefit one at the expense of the other.
And this one's probably going to be in our toolbox discussion in our next episode of these credits. So let's talk about a few other bombs here. Which one do you want to go to next, Andy?
Our friend Irma.
Irma.
So
let's call
Irma
him
is an acronym.
Yeah, go ahead. I just
Ernie?
feel we need to have a masculine name. Let's call him Ernie or something. Ernie.
All right.
I don't know.
Ernie, a.k.a. Irma. So stands for income-related monthly adjustment amount. All said and done, it's basically an income-driven surcharge of additional premium that you may have to pay on top of your base Medicare premiums. If you, let me give you the levels for this year. If you are single and you have more than approximately $90,000 of income, gross income, you will start paying more for your Medicare premiums in 2 years. Right. Let's back up a second. So here's what happens. You start Medicare when you're 65. Well, most people. If you're covered by an employer, you can extend it, but generally everyone starts at 65. The income that they look at to gauge whether or not you're subject to these IRMA surcharges, these Ernie surcharges, is based on your income from 2 years prior. Why is that? So here's an example. Let's assume you're on Medicare. Your 2022 premiums will be told to you late this year in 2021. They will be based on the most recent tax return the IRS has for you, which will be the 2020 tax year. Therefore, your 2022 premiums are based on your 2020 income. That's why there's this 2 year sort of delay, if you will.
Well, if I retire at 65, and 2 years ago I made $400,000, so I'm definitely going to have Ernie in my life as far as this surcharge. How do I rectify that?
Great question. There are 8 life-changing events that you can use to get this IRMA surcharge waived. The most common one in retirement planning is, like you said, Roger, I was making $400,000 in wages. I stopped working. I start Medicare the next day. They're going to look at my tax return from when I was making a few $100,000. You're going to get hit with the highest IRMA add-on. Retirement is one of the 8 life-changing events. You would need a letter from your employer saying, yes, so-and-so retired as of this date. You would send that to the government with form SSA 44, I think it is, and you would fill it out, and you basically prorate and adjust your income. You say, yeah, I realize my income on my last tax return is $450,000, but 400 of it was wages that have since gone away. So my real income going forward is only like $50,000. They will look at that. They'll say, okay, cool, we agree. They will then, waive out the IRMA, and then that's how I do it. Now, there's some things that aren't waivable. Like I mentioned, it's only 8 qualifying events. It's like marriage or death. It's retirement. It's a one-time settlement of some sort. Things like you choose to sell a rental property you've owned for a while. You sell it at a big gain. That gain is a one-time event that will spike your income, but that's not waivable. That was something you consciously chose to do. That will impact your IRMA.
Any
that will
kind
be
of
factored
long
in.
term, any kind of gain realized at all.
Any gain realized at all. Roth conversions as well. The income generated from Roth conversions will be factored in and is not able to be, stripped out, if you will.
And so the consideration there would be if you want to do major Roth conversions or you want to realize major gains, you want to do those a couple years prior or before age 65 or when this could become effect, because they're not going to be waivable, as you say, right?
Correct. Yeah. If you can control it, do it prior to turning 63, because remember that 2-year lag. So the income in the year you're 63 is what will be used to determine the Ernie Medicare surcharges starting when you're 65.
And so
there's
Andy,
a fairly limited window.
Go ahead. Yeah. Okay. So Andy, if
that's what I
you're,
was gonna say.
and that's rolling every year that happens. So when I'm 69, it's going to look 2 years back at what kind of income, and it will fall off. My surcharge will go away, or it will introduce, or it'll stay the same based on that lag. Correct?
That's correct. Every year they readjust, in November, December, when they tell you what your next year's Medicare's premiums will be, they readjust based on looking at your most recent tax return. So to the extent you had a freakishly large year of income, you had IRMA for 1 year, the next year, assuming your income dropped, that will roll off. Your IRMA surcharge will be reduced, if not eliminated. Yeah.
And then what happens if I paid too much in surcharges or too little? How does that get reconciled, or does it? Because you give them an estimate, don't you? Or they actually go to the tax return?
I should know that. I don't think it gets reconciled. It's based purely off your income 2 years prior. So if your income 2 years prior was high because you did a Roth conversion.
You know what I'm thinking about? I was thinking about ACA subsidies.
Right. Different story.
The credit,
right.
Because that gets rectified. Because when you go step back a second, if you're applying on the Affordable Care Act website, healthcare.gov, you have to tell them what you project your earnings to be.
Correct.
And they use that to base the subsidy or no subsidy that you would get. And so let's say you're in that window, and so you get a huge subsidy, and then you get a great consulting gig and you earn a ton of money. That's going to get reconciled when you file your tax return, right?
Exactly. And if you end up your income's higher than what you projected it would be, you have to pay back some or all of these credits you were paid in advance. That's right.
Or you get them if you thought you were going to have a lot of income and you don't.
Yes. Right. Exactly. It works both ways.
And I don't think there's a penalty. It's just a reconciliation.
There's no direct penalty for overstating your income, but I think any tax any credit you end up owing back may get lumped in with whatever other taxes you may owe, and to the extent that's high enough, you may be subject to an underpayment penalty on it.
Okay.
I think
we're getting a little geeky here, but
yeah,
I wanted to point that out.
Sorry.
Okay.
Yeah.
We'll close ACA back. Anything else we want to talk about when it comes to Ernie?
Just so people know the sizes we're talking about. For example, in 2021, the Part B base premium is $148.50. The IRMA surcharges, inclusive of the surcharges, I should say, your Part B premium may be as high as $504.90. So do the math. That's what, $350 or so of surcharges. Now that applies to single folks with incomes over $500,000 or married folks with incomes over $750,000. So these IRMA amounts, these IRMA surcharges can be quite substantial if your income is relatively high.
And we, in the important numbers document that we shared in Six Shots Saturday last week, you'll have this on there. And we probably should just put a link to that in every Six Shots Saturday email we send this month. And if you're not on our Six Shots Saturday email, which is just a weekly email where we share quick tips, but this is how we share resources, you can go to rogerwhitney.com and sign up for that on the bottom. We promise not to spam you. All right, the next one.
This one should be short and sweet. The net investment income tax, NIIT, which I call NIT. This is something put in place last 10 years or so. It was partially to help fund the Affordable Care Act, actually. What it is for a married couple filing joint that has $250,000 or more of gross income, technically modified adjusted gross income, but $250,000 or more. all of your passive investment income, dividends, interest, capital gains, be it long-term or short-term, rental income, certain royalties, all of those in excess of $250,000 will have an additional 3.8% flat tax applied on them on top of whatever other tax they already had. If you're single, that income level is $200,000. So this isn't retiree specific by any means. This applies to everyone, but just something to keep in mind. If you are a higher income retiree, whether it's because of large Roth conversions, really juicy pension, Social Security, deferred income that you chose to pay out from your previous employer, keep NIT in mind because it will add 3.8% to your passive investment income if you're over those income thresholds.
And I think the last one is probably like RMDs, Andy, one of those that people don't factor into their planning near enough. We tend to think about our life as we are now. Right? I've been married 31 years next month. I'm a married dude, right? So I will have marriage tax brackets, right? The joint.
Yes.
Or I have a buddy who I just talked to yesterday, actually, who has been single for 43 years. He's about 45 years old. For his life, I am a single dude. Well, and now he's married. And these things happen in retirement, right? Married people become unmarried either by the death of a spouse or divorce, great. And single people become married. That's really important when we're managing taxes. Why don't you talk about that, Andy? Why is that so important?
Sure. So obviously divorce, which you have at least one party has some control over, but death of a spouse, there's something called the widower tax penalty. Now that's a little clickbaity. It's not really a penalty. It's just the nature of how the tax code operates. And let me explain what I mean by that. So like you alluded to, Roger, when you're married, you're under one set of tax brackets, tax rates. Those income brackets are double the size of what they are for single people. So all else equal, for a given amount of income, married folks will pay less in total taxes than single folks will, just because of these larger brackets for married people. So if you're married, you're chugging along, you have your income plan, you're taking your distributions, etc., great. One spouse passes, what happens is now the surviving spouse is now under these single tax brackets. So the income brackets at which the tax rates are triggered are now condensed. They've been cut in half. Now, you may say, okay, but aren't I going to have less income in the first place as a result of the other spouse passing? And the answer is, yeah, to some extent, but maybe not as much reduction as you would think. So fairly typical example, married couple, each has Social Security, they each have an IRA they're pulling distributions from, and maybe there's a pension in the mix. When one spouse dies, yes, one of those Social Securities goes away. So that does drop. But what if the pension has a full survivor benefit? That lives on just the same. The IRAs, typically the surviving spouse has made the beneficiary of it. So the IRAs are still there, which means the RMDs are still there just the same. So no, the income for the surviving spouse doesn't necessarily drop a lot. So the taxes are going to go up on it. And to add insult to injury, the surviving spouse's expenses may not go down as much as you would think they would.
Yeah, they typically don't.
Right. You'll have some less healthcare expenses, obviously less food and clothing, maybe one less car, but otherwise you're still maintaining the same home, probably still have the utility bills, still need to eat, things like that. So your expenses don't drop a lot, your income drops some, but your effective tax rate probably goes up markedly. That's the widower tax penalty.
So you end up moving up the tax brackets more quickly.
Yes.
For a given dollar. Yeah. And the required minimum distributions are a great example. If you've got a couple, they're both 60, we assume they live to their 90s. Well, what happens if one of them passes away at 70? All of a sudden, the tax situation changes. The income, because part of Social Security goes away, changes.
Right.
We don't think about those things a lot, of taking advantage of the marriage brackets. And this is one of those eventualities that we can't really handicap very well, right?
No, not at all. Other than in the event where one spouse becomes terminally ill, then you sort of know, not that tax planning should be your priority at that point, but something to keep in mind nonetheless. You may only have, 1, maybe 2 more years of married tax brackets. So if you're going to do some longer term tax planning, again, life and health situations take priority over this, but if you have the willingness and ability to do some tax planning, maybe now you jam it in while you're still under the married tax brackets. So in the year of the spouse's death, the surviving spouse can still file a joint tax return for that year. Whether the deceased spouse died January 1st or December 31st, the surviving spouse is considered married the whole year. So take advantage of that if you can.
And I had this situation come up about a year ago, Andy, where it was an older gentleman and he had a longtime girlfriend. It's funny to think of someone, 75 having a girlfriend, but cool. And they were considering getting married. And there were some issues with the kids and things like that. And they ended up not, but as I'm, planning, I'm like, in my end, I'm like, it would be nice if you got married from a tax perspective.
Right.
But that is definitely the tail wagging the dog. And I'm surprised I haven't read any articles about that. We hear about
Social Security as well.
Reward.
Like ability to get survivor benefits or even spousal benefits while you're alive, you have to be married. I don't think there's any sort of common law thing, in the eyes of Social Security at least.
Yeah, I'm surprised I haven't seen the articles on that. We'll call it gray marriage, or I don't know, something where you get married. But I think that's a big one that we need to think about. All right, Andy, we have talked a lot about the bad or the potentially bad. Next week, we're going to change our focus, which we always need to do, and talk about, what tools do I have to manage this? So we're going to get a little bit more positive and not being fear mongers or bomb mongers here. And then in the last episode, we'll talk about how do we integrate this so you can take advantage of some of this this optimization area. Sound good?
Perfect. I like it.
All right, well, let's set a smart sprint for the week. In the next 7 days, I want you to set a little baby step you can take. It's not just rock retirement, but rock life. And I'm going to go back to that important numbers worksheet checklist, I guess we'll call it, that has tax brackets, things about IRMA, Social Security taxation, etc. We're going to send that in our 6-Shot Saturday email. Get that at rogerwhitney.com. Just spend some time looking at the different subjects. You don't have to become an expert on this. I have no interest in becoming an expert on this. I want to be aware of them and bring in the experts to help navigate it. But just spend some time understanding these, because that's the first step to empowerment. All right, Andy, next week we get to be positive and break out the toolbox.
I like it. It's going to be delicious and invigorating at the same time next week.
All right, everybody, have a wonderful week.
Take care.